If you're trying to figure out the best dividend ETF for you to invest in, this is the video for you. These are the 10 most popular dividend ETFs ranked by assets under management. I'm going to rank each one of these ETFs using a 50-point scoring system based on 5 different metrics, one of which you will not find anywhere else. Of course, we'll look at the historical ETF returns. I'll also take a look at risk, looking specifically at the Great Financial Crisis of 2007 through 2009. We'll look at fees, and then I'll score each one of these ETFs by the underlying methodology that the index itself follows. So this tells you exactly how does this particular ETF end up with the stocks that it has. ETFs follow an index, which is where you can find secret ETF performance, and that is looking at the actual index itself. The problem is that this data is not very widely available, and if you have this data, you can look at these ETF underlying indices returns going back way farther than what the actual ETF will show you. For example, one of the indexes that we're going to look at has performance going back as far as 1989, when the actual ETF itself has data only going back to 2006. I'll share with you which dividend index outperformed the S&P 500 by 711% since 1999. I'll explain why I think Vanguard's flagship dividend ETF is no longer a top pick for dividend investors, which means that there is a new pick for risk reduction if you're looking for an ETF that will minimize downside in a recessionary environment. And if you're just looking for a dividend fund that's most similar to the S&P 500, I'll share that with you as well. And of course, I'll share my #1 overall pick for dividend ETFs, combining all 5 of these metrics. If you're new to the channel, welcome. My name is Nathan Winklepleck. I'm a chartered financial analyst and a full-time investment professional for a firm that manages over $3 billion in assets. I'm also the author of Dividend Growth Machine, an Amazon #1 best-selling book. This is a great introduction to dividend growth investing, so if you're interested, I'll put a link in the description down below. At the very bottom of my rankings, I have DVY. On my 50-point scoring system, DVY scores just 10 out of 50, with bigger numbers being better. On this radar chart, you can see how DVY scores on each metric, starting with index performance, where it gets a 4 out of 10, downside risk, where it gets a 2 out of 10, ETF performance, it gets a 1 out of 10. Methodology, I gave it a 1 out of 10. I'll dig into each one of these. Let's start with index methodology. This is how the underlying index, which is the Dow Jones Select Dividend Index, selects the stocks that go into it. You cannot actually invest directly into an index, which is why ETFs exist. They track these indices as best they can. So this index is formed on this criteria. First, it requires the current dividend be greater than the average of the last 5 years of dividends. Importantly, it's not 5 years of dividend growth. If the dividend is currently 2 and the 5-year average is $1.50, then it passes the test. It also requires that the average of the last 5 years dividend payout ratio is 60% or lower. It requires that it pays at least 5 years of dividends, not dividend growth, just paying dividends, period. The minimum market cap is $3 billion or more. Each stock has to have a positive trailing 12 months earnings per share. The daily volume has to be at least 200,000 shares. This is very common for liquidity's sake. And then any stock that passed all of these screening criteria is then ranked by dividend yield. The initial portfolio is simply the top 100 dividend yields that pass those criteria. And then after that, and then in each subsequent rebalance, it's going to prefer to buy the top 100, but if there's another stock that it holds already that's in the top 200, it's held. The weighting is then market cap weighted across those 100 stocks, and that's limited to the lower of either 10% or 5 times whatever the market cap is of all index constituents. And then also no sector is allowed to be over 30% weighted. This is the ETF total returns net of management fees for DVY compared with the dividend ETF average. Now this is the average of all 10 on my list. So you can see how DVY compares. Very similar over the last 15 years, but over the last 10 years, 5 years and 3 years, DVY has underperformed. It's only been in the resurgence of the high dividend yield stocks, particularly utilities and a lot of financials, that DVY has done well so far this year. Over the last year, it has outperformed the average dividend ETF. However, it's failed to do that over the longer time periods. And if we look at the index itself, and just a reminder, this is not investable, this is just what DVY tracks. This shows the growth of $100,000, and I went back as far as I could on the left, back to January 1st, 1992. Then I also went back to 1/1 of 99 and 3/17/06. I picked these specific dates so that it makes a lot of these indices comparable. You'll notice that a lot of them had performance data going back to 06, which allows us to compare how each index did at each point in time. This is very important when looking at performance. You want to make sure that whatever you're looking at, A, compares with B over the exact same dates. Otherwise, it's impossible to compare them in a fair way. This is the Dow Jones Select Dividend Index, the growth of $100,000, and you can see that it dramatically outperformed the S&P 500 going back to 1992. Keep in mind this has no fees or no other transaction costs, including slippage, bid-ask spreads, taxes, that sort of thing. Of course, neither does the S&P 500 index, but generally these indices tend to be higher turnover, so there will be greater costs associated with them. So just because the index says it would have beaten the S&P doesn't necessarily mean that after all costs, you would have done so. But index to index, this performed favorably compared to the S&P back to 92 and back to 1999. However, if you look at it back to 2006, you can see that DVY has significantly underperformed the S&P 500. And if we look at fees compared with the average dividend ETF, DVY comes in at 0.38%, which is significantly higher than the average ETF on this list, which comes in at 0.24. And perhaps worst of all, this index has shown terrible performance in recessionary environments. Top to bottom, from October 2007 to March 2009, the Dow Jones Select Dividend Index declined by 60% compared with the average dividend index on this list at just 52%. Coming in at number 9 is the ETF SDY. SDY scores a 22 out of a maximum of 50. And you can see how it scores on each one of these criteria, which I will go into in more detail. Starting with the index methodology, SDY tracks the S&P High Yield Dividend Aristocrats Index, which starts with the S&P 1500, which is large caps, mid caps, and small caps. It requires at least a $2 billion market cap and average daily trading volume of 5 million or more. This fund requires 20 consecutive years of dividend growth. And whatever passes these criteria are then dividend yield weighted. No more than 4% of the index is allowed to be in any one particular stock, and no stock is allowed to have a weighting of greater than 30 times its weighting in the S&P 1500. This is SDY's total return, meaning dividends reinvested, net of all management fees, compared with the average ETF on the list. You can see that it has underperformed in literally every single time period: 15, 10, 5, 3, and 1 year. And if we look at the underlying index performance going back to 1999, as far back as it had data, it shows much better performance, actually doubling the S&P 500. And that just goes to show that a lot of times longer term performance data is not going to be equivalent to the ETF performance. So if you tend to favor more of the hypothetical performance, then index data could be appropriate to look at. But if you're looking for more real world data, then ETF returns would be more important to look at. Just like with DVY, we see that since 2006, this index has also underperformed the S&P 500. It also has higher fees, 0.35%, but it did perform better during the Great Financial Crisis, going down the exact average of the rest of the dividend ETFs on the list. Tied for number 7, we have RDVY. It scores a 24 out of 50 and has particularly excellent scores when it comes to index performance and ETF performance. So if you're looking for performance only and you don't care about anything else, this could be a consideration for you. RDVY follows the NASDAQ US Rising Dividend Achievers, and it requires that the company have a higher dividend yield over the last year Then it had the prior 3 and 5-year periods. So if the current dividend is $2, 3 years ago it was $1.50, and 5 years ago it was $1, it would pass the test. If, however, the dividend was 2 3 years ago and 1 5 years ago, it would not pass the test. They also require positive earnings in the most recent year, and those earnings have to be higher than the 3 years prior. It also has some debt ratios, so the cash to debt ratio has to be at least 50% or more. The payout ratio has to be lower than 65, and then it ranks to find the top 50 stocks looking at 3 different criteria. The first is the dollar dividend increase over the past 5 years. This naturally favors higher market cap stocks. It also uses dividend yield and then payout ratio, the lower the better. And once it has the top 50 stocks that pass these criteria, it equates those stocks. This is how the actual ETF performed. Over the last 15 years, it didn't have any data, but you can see that it's been quite favorable compared to the average dividend ETF over the last 10 years and 5 years, as well as the last 1 year. The only time it underperformed the average dividend ETF was over the last 3 years. Index performance is also pretty strong. Unlike with these other indices we've seen so far, this index outperformed the S&P 500 going back to 2007. Just keep in mind the other indices were looking back to 2006, so this is not directly an apples to apples comparison. It's also performed well since 2013. Unfortunately, this ETF has one of the highest fees on the entire list, coming in at 0.49%. It also slightly underperformed the average dividend index, down 53% from 2007 to 2009. Tied with RDVY was VYM. It also scored 24 out of a maximum of 50, and its strong suit was fees and methodology, where it was weak in ETF and index performance. So you can see that based on what your specific needs are, that determines which ETF you should invest in. So just because I have it as a higher or lower ETF doesn't necessarily mean that it's right or wrong for you. The index methodology for VYM comes from the FTSE High Dividend Yield Index. It sorts stocks based on the forward dividend yields based on dividend estimates, which is kind of interesting. So it's looking at analyst estimates for dividends and then taking the highest yielding half. It's also market cap weighted, which tends to mean lower transaction costs. Any stock that's not forecasted to pay any dividends over the next 12 months is removed. It also has no REITs allowed. They also apply a proprietary screen. As alluded to, VYM doesn't have great performance. 15 years, it's been about the same as the average dividend ETF, but it's underperformed over the last 10 and 5 years, but it has outperformed over the last 3 years and over the last 1 year. If we look back to longer-term index performance, you can see that it has underperformed the S&P 500 back to 2003 and also back to 2006. Where VYM really shines is in its 0.6% fee, which is the lowest, tied for the lowest on this list, significantly lower than the average dividend ETF. Unfortunately, its downside returns have not been very good, coming in well below the average dividend index. So if you're looking for downside protection, VYM may not be the best choice for you. Coming in at number 6 is VIG. This ETF used to be much higher on my list, but for reasons I'll talk about in just a second, it's significantly lower heading into 2025, at least in my opinion. 28 out of 50, with its strongest points coming in at fees, downside risk, and ETF performance. However, this ETF performance is partially because this used to follow a different index, which is one of the reasons why I don't like this as much. I don't think the index that it now tracks is as good as the one it used to track. The current index that VIG follows is the S&P US Dividend Growers Index. And that index also does not allow any REITs. It requires a minimum average daily trading volume of $100 million. All stocks in this list have to have at least 10 years of dividend growth, and then it ranks them by dividend yield, eliminating the top 25%. That's right, so if it has a 6% dividend yield, and that's the #1 dividend yield on the list, it's actually going to be completely eliminated from consideration. If you're a dividend yield chasing investor, which sadly a lot of people are, That may not appeal to you, but the whole idea of this is that they want to try to get rid of companies that are more likely to cut their dividends. I think there's better ways to do this, which is why I rank this index methodology a little lower. And it also does not allow any stock to have more than a 4% weighting. This is the VIG ETF performance, which, like I said, is a little bit misleading because now it follows a different index. So some of this performance was because of the other index. But this is where it really shines. It actually has outperformed 15, 10, 5, 3, and 1 year. So just looking at ETF returns, VIG is one of the best. But when it comes to the actual index performance, going back to 2006, it shows underperformance relative to the S&P 500, which makes this one of the most confusing ETFs to try to decipher. On one hand, the index doesn't look that great, but the ETF looks amazing. Speaking of amazing, the 0.06% fee is tied with the best, and the index itself has had better than average downside protection. However, this is not as strong as the original VIG index was, which is one of the reasons why I liked the old VIG index so much. It performed so well in down markets, and the new one, I'm afraid, just doesn't have that same downside protection. Coming in at tied for number 4 is DGRW. This scored a 29 out of 50 overall, with its strongest point coming in at ETF performance. It also scored quite well on methodology. Unfortunately, downside risk was a bit of a struggle and kept this ETF back. However, the methodology here is quite interesting. The focus here is very much on businesses with strong growth properties and wide economic moats. It's a custom index by WisdomTree, which also sponsors the ETF. It's the WisdomTree US Quality Dividend Growth Index. It starts by filtering out all stocks with a payout ratio above 100%. They have to have a $2 billion market cap or more. There's an 8% maximum weighting of any stock in the index. I really like this. It ranks each one of the stocks by whatever their medium-term estimated growth rate is. This is probably like 3 to 5 year analyst estimates. It also takes the 3-year average of return on equity and return on assets, which make up the other 50% of the equation. And then it takes the top 300 companies ranked by this formula and then removes small caps, leaving only large or mid-cap stocks. They also have a limit on the sectors. So the tech sector specifically has a 30% limit. The real estate sector is allowed, but it has a maximum 10% weighting, and all others are 20%. So if you're looking specifically for maximizing growth, DGRW could be a great dividend fund for you. And since growth has performed so well over the last decade, you really see that in the performance. It has no 15-year history. However, you can see that its performance over the last 10, 5, 3, and 1 year have been absolutely phenomenal compared with the average dividend ETF. So if you're someone that thinks growth stocks are likely to continue outperforming, but you want to be in the dividend growth universe, this is probably the ETF for you. The historical performance back to 2013, which is when this index originated, is just slightly higher than the S&P 500. The fees are a little bit greater than average, but considering the unique structure of this ETF, I think it makes sense. 0.28 compared with 0.24. It does not have data going back to 2007 to 2009, which is another knock against this ETF. We just don't know how it's going to perform in a recessionary type environment. Tied with DGRW is DGRO. It also scores a 29, and its strong points are downside risk, historical ETF performance, and fees. It tracks the Morningstar US Dividend Growth Total Return Index, which requires that stocks have a payout ratio of less than 75%. And just like VIG, it takes out the highest dividend yielding positions, only instead of 25%, they use a 10% cutoff. It requires 5 years of dividend growth and a positive earnings forecast. Just like some of the others, it also takes out REITs. ETF performance has also been sensational, outperforming over the 10, 5, 3, and 1 year. However, the underlying index performance has been a lot more mediocre. It's slightly underperformed the S&P back to 2003 and slightly outperformed back to 2006. The fees are 0.08%, So it scores well if you're looking for a low-cost ETF. It also scores quite well when it comes to downside protection, coming in at the second to best overall of all the ETFs we're going to review. Coming in at number 3 is Noble. Noble was the best overall fund when it came to protecting downside risk in 07-09. It also has a relatively strong methodology and decent index performance. However, it lacks in fees and ETF returns. Noble follows the S&P 500 Dividend Aristocrats. It buys all the stocks in the S&P 500 index that have 25 plus years of dividend growth, and then equal weights those as long as they have at least a $3 billion market cap and average daily trading volume of 5 million. If you run into a scenario where no more than 40 stocks have 25 years of dividend growth, then the hurdle reduces to 20 years. If that still doesn't result in 40 stocks, then it picks the highest dividend yielding stocks. It also has a sector limit of 30%. Unfortunately, the ETF performance has been pretty poor compared to the average dividend ETF, underperforming over every single time period, particularly poor over the last 1 year. The index performance, on the other hand, looks quite good. If you look back at 1989, which is the furthest back the indexes show, the S&P 500 Dividend Aristocrats have dramatically outperformed the S&P 500. They've also done that since 1999, since 2002, and 2006. However, you can see that the performance gap has narrowed. It also has quite high fees, particularly considering the low turnover nature of this index. I think if you're looking for something like this, you could pretty easily just buy this index on your own with individual stocks. Not that hard to buy the 40 or so companies that have raised dividends for 25 consecutive years, and you could save yourself this 0.35% fee. We'll talk more about creating your own index fund here in just a second. But the strongest argument for Dividend Aristocrats, and by extension the Dividend Aristocrats Index, is the downside protection that it provides. While this fund was still down 47% in 08-09, that's significantly lower than the broader market and lower than the average dividend index. So if you're someone that's interested in maximum downside protection, the Dividend Aristocrats Index could be a consideration for you. Coming in at number 2 is FNDX. This fund got a 37 out of 50 on my scoring system, with index performance, methodology, and ETF performance strong, while the fees and downside risk were both average. This fund follows the ROFI Fundamental High Liquidity US Index, and it's one of the most complicated methodologies on the list. It creates fundamental weights using the following formulas. First, it takes the adjusted sales average over the last 5 years and multiplies those by the average equity divided by average assets over the last 5 years. In other words, it's pushing for companies that have less leverage and high sales, i.e. bigger companies. The other part of the formula is retained operating cash flow, which is the operating cash flow minus dividends and buybacks of the last 5 years. So it's favoring companies that retain a lot of their operating cash flow to reinvest back in the business. Finally, it looks at dividends plus buybacks averaged over the last 5 years. The lowest 2% scoring of the universe is completely removed, and then the rest are weighted by this fundamental scoring system. And what that means is that it tends to buy losers and sell winners who have declined relative to their fundamental weights. So if it continues to score really well, let's say it scores 98 on this fundamental weighting, but the price declines from 100 to 50, it's naturally going to increase the weighting of this stock even as the price falls. And since it basically keeps 98% of the universe, so if you're just looking for broad diversification into a more fundamental shareholder yield type strategy, this could be a good choice for you. Performance has been relatively good compared with the average dividend ETF, outperforming over every single period. The index is also quite strong. If you look at it compared with the S&P 500, it's outperformed since 02 and 06. Its fees are slightly higher than average, but considering the unique methodology and excellent performance, I think that is well worth it. Downside protection has been right on par with the average dividend ETF, but compared with the S&P 500, which was down 55% over this same time period, it's still outperforms slightly in 07-08. Finally, number 1 overall is SCHD. This scores a 43 out of 50 overall. Gets a maximum 10 out of 10 points on index performance, fees, and methodology. Scores quite well on downside risk, but if you look at the actual ETF performance, it's been a little bit disappointing. So don't just assume this is the best ETF for you. If you care a lot about historical performance, there's been better options. SCHD follows the Dow Jones US Dividend 100, which requires 10 years of dividend payments, not growth payments, a minimum market cap of 500 million, so it's a little smaller on the scale, whereas others require 2-3 billion. It does require a 3-month average daily trading volume of 2 million plus for liquidity. I really like the formula a lot. It creates a composite score that uses free cash flow from operations, so it's going to tend to buy companies with more free cash flow, including bigger companies. It also includes return on equity, indicated dividend yield, meaning what the company has announced it will pay, and 5-year dividend growth. All 4 of these metrics I think are excellent for identifying high-quality dividend-paying companies. It then scores and takes the top 100. If the stock is in the portfolio and it still ranks in the top 200, it's not sold. It's only sold after it drops below 200. There's a 4% limit on each individual stock, and no sector is allowed to be above 25. ETF performance has been excellent over the 10 and 5 years. However, the last 3 years and particularly 1 year have not been great for SCHD, where it's underperformed the average dividend ETF quite significantly. The index performance, on the other hand, is quite strong. If you look back to 1999, it outperformed the S&P 500 by a pretty significant margin. This is the index that SCHD tracks, but it outperformed the S&P index in 02 and since 06. The fees are also tied with the best at 6 basis points. And then downside protection has been not the best of the entire list, but still better than average. But what if you're someone that does not want to buy an ETF? What if you want to do individual stocks? Well, as you've seen, there are a lot of different methodologies for these dividend indices. And one thing you can do is actually create your own dividend index. I've tried to do that. I've taken what I consider to be the best index methodologies and combined them into the Coffee Can Top 100, which is the top 100 dividend stocks based on the same methodologies we see in the dividend indices, but I've basically tried to create my own index. So I'm going to be tracking the performance of that index over time, about 100 stocks, $100,000 worth of just fake money. So we'll track this index over time and see how it performs relative to SCHD, relative to DGRO, DGRW, and all these dividend ETFs. So if you're interested in tracking along with that, I'll post the performance over on my Patreon page periodically when I do the rest of my Coffee Can updates. I'll also post for Patreon supporters the entire list of top 100 stocks. So if you're interested to see which stocks make the cut, check that out. I'll put a link in the description down below.